bonds, treasury bonds, municipal bonds, corporate bonds. Let's face it, we've had a love affair with bonds for the last 30 years. They've been very, very good to us. Well, last week the Fed raised the benchmark interest rate and forecasted that they're likely going to increase it at least 3 more times before the end of the year. So this begs the question, is our love affair with bonds coming to an end? Hey, my name is Roger Whitney. I am the host of the Retirement Answer Man Show, and we are dedicated to helping you not just survive in retirement. We want you to rock retirement. So this is the start of a month-long series exploring this bond caper and getting an idea of what role bonds are going to have in our portfolio in the coming rising interest rate environment. So we're going to start off with getting a good foundation this month or this week of what bonds are. Next week, we're going to talk about the role in a portfolio. And then we're going to introduce the villain in this bond caper. And then we'll bring in Q to find out what gadgets we have to defeat or work to defeat this evil villain, which we might call interest rates. Spoiler alert. So today what I want to do is set the stage so we all understand what we're talking about when we're talking about fixed income or investing in bonds. But we can't do any of that until we have this all-important disclaimer. It's time for that all-important disclaimer. You know, I may need to change the disclaimer music because it sounds so ominous, and it is important, but the disclaimer is actually a really good thing. It is, don't take advice from me on the show. I'm not here to give you advice. I only give advice to clients that I work with. So before you make any decisions, talk to your legal advisor, your tax advisor, or your financial advisor. There we go. That's the one. Because this is just helpful hints and education, and you need to make the decision right for you. Now, let's get on and learn about this love affair we have with bonds. So in the news today, there are rumors coming about the potential rocky relationship between investors and fixed income or bonds. Now, this has been a storybook relationship over the last 30 years. Investors have really just fallen in love with bonds, and we've all thought that this relationship would probably last forever. But there seems to be storms on the horizon. I think the Barclays aggregate index is down over 2% this year, as we're starting to see some increases in interest rates and forecasts that interest rates are going to continue to increase. So let's talk about this for a second. And we're all old enough here to remember some of this. So back in October 1981, the 10-year Treasury, I think it was the 10-year back then, had a yield of 15.21%. Do you remember those days when you could buy a bond? You could buy a Treasury bond, at the time AAA rated, and they would pay you 15% on your money every single year. This was back when Paul Volcker, as chairman of the Fed, was battling inflation that we had coming out of the 70s. And it didn't really feel like a deal back then because we had inflation that was so high as well. But that was the peak of the bond market back in October of 1981. And since that time, I think I was a freshman in high school, we have seen a steady decrease in interest rates for, what are we at, 37 years? It's been 37 years since I have been a freshman in high school. Oh, I feel old. Well, back in August 2016, we saw the 10-year Treasury yield bottom, so far anyway, at 1.5%. So over those 37 years, we've seen a steady decrease in interest rates from over 15% down to 1.5%. And right now, the yield on the 10-year, I believe, is around 2.6%. So it's started to slowly inch up. And there's talks that the Fed is going to continue to slowly raise interest rates. One, we're still abnormally low from the long-term averages. As you'll find out as we dive deeper into bonds, that when interest rates go down, the value of bonds in the market goes up. So they're inversely related. So it's like, for me, I'm a cyclist. It's like riding a bicycle and having this huge wind, big strong wind at your back for the whole ride. And any of you that have ridden or maybe run, or when you have the wind at your back, you feel really fast and it's really easy to move forward because it's pushing you along. Well, that's what we've had in the bond market, or if you've been a bond investor for 37 years, pretty much. Well, the question is that wind turning around? Are you going to start having a headwind or a wind blowing at your face? And when you've had that wind at your back for a long time and you turn around to go the other direction, holy cow, it gets a lot harder and it feels like you're going a lot slower. Sometimes it feels like you're going backwards, which could actually happen in bonds. So we'll get into that. So what do I mean by this? Well, let's look at bond returns, and I'm going to look at the 10-year Treasury. Since 1981, the average return on the 10-year U.S. Treasury bond has been just over 8% a year for the last 37 years. So if you looked at the average return of a Treasury bond for the last 37 years, it's been about 8%. Not bad. The worst year in bonds in the 10-year Treasury over the last 37 years has been a year where we had a negative 10%. And that's actually the maximum drawdown we've had. It's a little higher, but the maximum drawdown means from the very peak to the very bottom in a return sequence. So in that 37 years, you're clipping on average about 8% a year because you get the coupon or the interest from the bonds. And we'll talk about this in a second. And bonds have been moving up in value because interest rates have been going down. And the worst year you've had is one year you lost 10%. And I think that was back in 94. So that was a long time ago. So compare that to the U.S. stock market since 1981. So in the U.S. stock market since 1981, it's been an average annual return of 10.4%. Pretty impressive. Higher than bonds, but not that much higher, considering that the worst 1 year in U.S. stocks, looking at the S&P 500, was negative 37%, with a maximum drawdown, and this was in the 08 crisis from October 07 to March of 09, over 50%. So let's see, in the last 37 years, you could have been just in U.S. Treasuries and earned about 8% a year, with 1 year where you had a 10% drawdown. Or you could have been in equities, earned a couple percent more a year, but had some really big volatility all along the way. It's been a Goldilocks season for bonds for 30 plus years. Oh, by the way, because I don't think I've mentioned this, if we talk about indexes like the S&P 500 or the Barclays Aggregate Index, realize you can't invest directly in an index. Past performance is no guarantee of future results. And you can only buy things that might mimic an index. So with all that on the table, just make sure I get that little disclaimer out there as well. So it's been a very long love affair with fixed income. So the question is this love affair coming to an end now that we're slowly seeing interest rates start to increase? Now, full disclosure here, I can remember having conversations 14, 15 years ago thinking that interest rates were going to be on the rise. So we've been wondering when interest rates are going to start moving up because traditionally we've gone through cycles of rising interest rates and lowering interest rates. And because of various things, the market meltdown in 08 and things like that, we have just kept going lower and lower and lower on the interest rates trying to jumpstart the economy. And inflation has been at bay. So we haven't had inflation to deal with, and we're at almost full employment, supposedly. So just because we're talking about now we're starting to get some rises in interest rates doesn't necessarily mean we're on some big, huge cycle up. But at some point, we should revert to the mean or get back to average interest rates, which means we have a lot more to go. So this is what we're going to cover this month. So I wanted to set the stage. What we're going to do in our practical planning segment next is just talk about, okay, what exactly is a bond and how do they work so we can have an understanding. And then we'll use this as a foundation for the rest of the discussion throughout the month of April. Sound good? All right, let's get on to practical planning. So to set the stage for this series on bonds and fixed income and their role in a portfolio, I think we better define exactly what a bond is so we're all on the same page. Well, to start off with, let's talk about the size of the bond market. If you look at all global bonds, they have an aggregate value of about $120 trillion. That's tripled in the last 15 years, by the way. $120 trillion. I have no idea how to describe how big that number is. Well, I guess one way would be to compare it to the value of all global stocks or global equities. So all global stocks, if you look at the market capitalization, they're valued at about $51 trillion. So you take all the stocks in all the world, put them all together as far as the value, about $51 trillion compared to $120 trillion in bonds. Isn't that crazy? We hear about stocks nonstop. We hardly hear about bonds, but it's much bigger. Historically, mainly that's because they're a lot less volatile. They return a lot less, and they're definitely not as sexy. So how exactly does a bond work? Just to make sure we're on the same page. So think of a bond as a loan to something else or someone else, because that's what it is. So let's say I have a cousin Joey, which I don't. Let's say I have a cousin Joey and I lend him $1,000. So Joey comes to me, hey, Roger, I need $1,000 for 1 year. Can you help a guy out? So I'm like, well, I like Joey. I'll help him out. So I say, okay, Joey, I will lend you $1,000 for 1 year. But I got a problem, Joey, is if I give you the $1,000, that means I don't have it. And I might be able to invest it. I might be able to spend it or save it. So I'm going to need some compensation for giving you this $1,000 for a year. And I was looking at roughly what a CD would give me over a year. And you're going to laugh, I'm just making this up. And a CD would give me about a 5%. So why don't you give me 5% of that $1,000 for every year you have my money? So, okay, Joey says, okay, I'm going to give it to you. I'm going to borrow it for a year. So I'll give you 5%. So I'll give you $50 in interest. And I'll pay you half of it in 6 months and then half of it at the end when I pay you your money back. So that amount, that $1,000, is what's called the face value or the amount borrowed, the amount that Joey borrowed. The coupon rate, which every bond has, is the amount of interest that the borrower is going to pay the lender. And usually it's done on an annual basis. So that's 5% is the coupon rate that we agree on when I lend Joey the money. And the maturity date is 12 months from whatever day it is I lend the money to Joey. That's called the maturity date. So those are the three basic features of a bond. Now, I'll give you a fourth feature that really isn't going to factor in right now, but it's called the credit rating. In the bond markets, it's Standard & Poor's and Moody's, and there are a few others that will analyze a company and say, how trustworthy are they in terms of being able to pay you back the money? So if Joey is true blue, I know he's got his act together. So I'm willing to take 5% interest, just like I'd get in a CD, because I feel like it's just as safe. But what if Joey has had issues? He's had issues with money management before. He doesn't have a full-time job, and he's been laid off once or twice. And so I got a little bit of concern lending Joey $1,000. So rather than charge him 5% like I'd get in a CD, it's going to be a little bit more risky, so I'm going to need to get paid a little bit more. So let's say I say, well, Joey, because of this, that, and the other thing, I think you should pay me 8% in interest. That is a factor that goes into the pricing of a bond and the value of a bond when it's initially issued. So that is bond basics, and I want to make sure you understand that from a very basic level. Now, in upcoming episodes, we'll talk about how the price of bonds can move based on interest rate movements. But for now, I want to make sure we have that base understanding of a bond. Now, what type of bonds are there? Well, the basic one, in which we talk about a lot in asset allocation, is the U.S. Treasury bond, which is bonds that the government issues, the U.S. government issues to fund operations. And historically, anyway, they've been considered the safest bonds in the world. For most of my adult life, they've been AAA rated, meaning they're true blue. So we have Treasury bonds, which are bonds issued by the United States government. We have corporate bonds because companies need to borrow money to build a plant or fund their operations or buy another company. So those are corporate bonds. And we all know there are really good corporations and, some more risky corporations. Municipalities borrow money for toll roads, for building a school, for building infrastructure. So municipal bonds is a huge market. And the little wrinkle with municipal bonds is because this is supporting our society, they're typically exempt from paying taxes on the interest on a federal level. So there are municipal bonds. There are international bonds because there are governments and corporations all over the world that borrow money for various reasons. Now, international bonds introduce a whole different dynamic because they don't all trade in US dollars. So if I'm buying a French bond, well, it trades in euro. But I live in America, so there's an exchange rate wrinkle in there because the exchange rate will matter in terms of return. And then there are private loans, or like me lending to Joey, there are corporations or even investment vehicles that will lend directly without going into the public markets. So they're all different types of bonds, and they all have various characteristics that we'll dive into a little bit as we deal with this interest rate environment. Now, how do you buy a bond? Well, you could go to your advisor or go to a brokerage firm and say, I want to buy a specific bond. You can research them on finra.org. There's ways of researching individual bonds. Most of the time, it'll say, hey, I have this much money I want to put in bonds, and I want to buy a 10-year bond of a corporation with this kind of credit rating. And then your advisor or the online firm will go find bonds and show you prices, and you can go ahead and buy it. And so you can own a portion of a huge bond offering. So say you only had $10,000 to invest, you could put that into an individual bond and then hold it to maturity, and the company, if they keep their promise, will pay you back, and then you'll get interest along the way. That's one way you can buy bonds, and that's buying them individually. The advantages of that are that you know that at maturity rate, assuming they keep their promise, that they will pay you back the amount that you borrowed, or they borrowed, and they'll pay you interest along the way. One of the disadvantages can be that the pricing, unlike the stock market, is a little bit more in the shade. It's hard to know how much, whether you're getting a good deal when you're buying a bond or not, unless you really know the market. And you are not very diversified because you have the credit risk of that one company. So if you're building a portfolio, you can end up wanting to have lots of, you want to diversify even in your bond portfolio. So that makes it a little bit harder because you can't track them near as well as you can track, say, individual companies. So it makes it a little bit harder that way. What a lot of people will use are mutual funds or exchange traded funds that buy big baskets of bonds, just like you would in, if you're buying equities in one of those vehicles. The advantages are that it's easy, right? You can buy that portfolio really quickly. And they have some that mimic the indexes that people use for bonds, the biggest one being the Barclays Aggregate Index. The other advantage is that you get to reinvest all those interest payments. So if you don't need the money, they can continue to buy more and more of the portfolio when they receive interest payments from bondholders. That's something you can't do with individual bonds. But one of the negatives is a portfolio executed that way never actually matures. So one of the advantages of owning an individual bond is, hey, when that particular bond matures, assuming they keep their promise, you get your money back. In a structured product like a mutual fund or an ETF, they're always buying more bonds and they're trading them within the account. So you never actually have a maturity, which can be problematic in rising interest rates, which we'll talk about, but that's another way that you can buy a bond. And then there are closed-end funds and lots of vehicles that you can own bonds in. So those are the typical ways, those 2 or 3 ways that people own bonds. So to summarize, this may have been very basic for some of you, but I think it's important in this first stage. We got bonds are basically a loan to someone else. Every bond is going to have a maturity date when the money gets paid back and an interest rate. And there are lots of different ways to buy bonds in the market. So what we're going to do next week is explore what role do bonds have in building a portfolio to help you support the retirement that you want. Why even bother owning bonds? What's their role in a portfolio? So that's what we're going to explore next week. But for now, let's spend a little time getting out of the weeds here and go get happy. Hey, welcome to the Happy Lab, where we noodle on being a little happier. Nicole, one of the things that makes me happy is when the right music hits me and gets me motivated. Music can change your mood, right?
Absolutely.
All right. So considering this whole month is about investing in bonds, what is your favorite bond soundtrack?
Live and Let Die.
Live and Let Die. Oh, wait. I can't sing on the show anymore. I'm sorry.
Some people wanted you to sing more.
Very few. Very few. That is actually my favorite song, too. And I'm not a big Paul McCartney fan.
I like the Guns N' Roses version better, but...
there's a generational thing there. All right, but that's my favorite. So my question to you is, what is your favorite Bond theme? Go play that and see if it gets you moving a little bit and gets you happier. I'll play the Guns N' Roses. I like that one, too.
On your marks, get set.
And we're off to set a smart sprint to take a little baby step to creating a betterer, greater retirement. So in the next 7 days, I want you to identify what kind of bond investments you actually have in your portfolio. You know, if it's your 401k or whatever account you have it in, why don't you print off a fact sheet from whoever manages the money and start to understand what you actually own, because that might be helpful as we go forward in this epic bond adventure to making sure that what you own is right for you. Hey, guess what? Now that we've changed the show a little bit and we're doing these monthly themes, one thing that I've realized, if you notice this, Nicole, we don't get to as many random listener questions.
Very true. We're getting quite a backlog going, actually.
And that's not good. And so what we've decided to do, because I like new, right, Nicole? Do I like new?
You do.
I do like new, is that we are really ramping up the Retirement Answer Man YouTube channel. So what we're going to do is answer on a weekly basis some of your questions via video on YouTube. So why don't you go to youtube.com/Retirement Answer Man and subscribe to the Retirement Answer Man YouTube station. And then we'll be answering listener questions and you'll get to look at me be a goofball rather than just listen to me be a goofball. So next week, we're going to get into how do bonds mix in the portfolio cocktail. I didn't say the title right, did I, Nicole?
No, that was...
What's the title?
As shaken, not stirred. How do bonds mix in your investment cocktail? There
you go. That's the title. So, shaken, not stirred. How do bonds fit into your investment cocktail? Meaning, what role do bonds play? Why do we even have them? So that's what we're going to do next week. You have a great day.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.